Hello and welcome to the Learning Corner. We're all about empowering you with knowledge and helping you understand the world around you better. Today we're going to dive into a topic that's often talked about but not always understood: stocks versus bonds. Before we start, make sure you've subscribed to our channel so you never miss out on our educational content. Your support helps us continue to provide these valuable resources. Don't forget to share our videos with your friends and family, leave a comment with your thoughts or questions, and give us a thumbs up if you find our content helpful. Let's get started with today's topic, shall we? Have you ever wondered about the difference between stocks and bonds? Well, let's demystify these two often mentioned financial terms. At a basic level, stocks and bonds are two different ways in which a company or a government raises money. When you buy a stock, you're buying a small piece of ownership in a company, sort of like getting a slice of a giant corporate pie. This piece of the pie may grow or shrink over time, depending on how well the company performs. If the company does well, the value of your stock goes up. But if it does poorly, the value of your stock goes down. The key takeaway here is this: stocks offer a way to share in a company's success or its failure. On the other hand, when you buy a bond, you're essentially lending money to a company or government for a set period of time. In return, they promise to pay you back the original amount you lent, plus a little extra, known as interest. The company or government uses this loan to fund projects or operations, and you, the bondholder, get the benefit of regular interest payments until the bond matures, which is when you get your original investment back. So in essence, stocks give you a piece of a company, while bonds make you a lender to a company or a government. Both are ways of investing your hard-earned money with the hope of seeing a return on your investment. But it's not all sunshine and rainbows. Just like any investment, stocks and bonds come with their own risks and rewards. Stocks can offer higher returns, but also come with higher risk, while bonds provide regular income and are generally considered more stable, but they may not offer as high returns. Now that we understand what stocks and bonds are, let's dive deeper into the pros and cons of each. So stick around as we take a closer look at the world of stocks and bonds, helping you make informed decisions about your financial future. Stocks can be a lucrative investment, but why is that so? Well, let's delve into the upside of stocks to unravel this mystery. There's a charm to owning a piece of a company you believe in, and stocks allow you to do just that. When you buy a stock, you're not just an investor, you're a part owner of that company. This ownership comes with its own set of perks, making stocks an enticing investment option. One of the major advantages of stock ownership is the potential for high returns. If the company you've invested in performs well, the value of your stock rises, leading to capital gains. Imagine investing in a small tech startup, and over the next decade, it becomes a tech giant. The value of your initial investment would skyrocket, providing a greater return on investment than most other investment avenues. But it's not just about capital gains. Many companies also reward their shareholders with dividends. These are portions of the company's earnings, distributed to shareholders on a regular basis. Think of it as the icing on the cake. Not only do you stand to gain from the appreciation of your stock's value, but you also receive a steady income stream through dividends. And let's not forget about voting rights. As a shareholder, you have a say in the company's direction. You can vote on major decisions, like who sits on the board of directors. It's an empowering feeling, knowing that you have a voice in the company's future. Moreover, stocks offer flexibility. You can buy and sell stocks relatively easily, making it possible to adjust your portfolio according to your financial goals and risk tolerance. In essence, stocks provide a blend of potential high returns, regular income through dividends, voting rights, and flexibility, making them a compelling investment choice for many. However, let's not forget that stocks are not a one-way ticket to wealth. The potential for high returns comes with its own set of risks, but we'll delve into that in our next scene. While stocks can be profitable, they are not without their pitfalls. The bright side of stocks, with their potential for high returns, can sometimes blind us to the darker side. It's important to remember that stocks are not a guaranteed path to riches. In fact, they come with a fair share of risk. One of the most glaring disadvantages of stocks is the possibility of losing your entire investment. Yes, you heard that right. If the company you've invested in performs poorly or worse, goes bankrupt, you could potentially lose every single penny you've put in. This is a worst-case scenario, of course, but it's a reality that every stock investor must be prepared to face. The stock market is also notorious for its volatility, Prices can skyrocket one moment, only to plummet the next. This can create a rollercoaster of emotions for investors, from the exhilarating highs of a booming market to the stomach-churning lows of a crash. This volatility can be particularly stressful for investors who need to cash out their investments in a hurry. If the market is in a downturn when you need to sell, you could end up selling your stocks for less than what you paid for them. Moreover, stocks are generally considered riskier than bonds. This is because when you buy a stock, you're buying a piece of a company, with all the uncertainty that entails. If the company does well, you stand to profit. But if the company struggles, so does your investment. On the other hand, when you buy a bond, you're essentially lending money to a company or government. You're promised a return of your money, plus interest, regardless of how well the entity does. In conclusion, while stocks can offer the allure of high returns, they are not for the faint of heart. They require a willingness to take on risk, a long-term perspective, and the emotional resilience to weather the market's ups and downs. So if stocks are risky, why would anyone consider bonds? Bonds, on the other hand, offer a safer investment alternative to stocks. So let's take a moment to appreciate the appeal of bonds. As you may know, bonds are essentially loans. When you buy a bond, you're lending your money to the issuer for a certain period of time. In return, the issuer promises to pay you regular interest payments and return your principal when the bond matures. One of the major advantages of bonds is these regular interest payments. Unlike stocks, where dividends can fluctuate or even disappear, bonds offer a fixed rate of return. This makes bonds particularly attractive to those who seek a steady stream of income from their investments, like retirees. Bonds also offer a return of principal at maturity. When the bond's term ends, the issuer repays the original amount you invested, known as the principal. This can be a comforting assurance if you're wary of the volatility of the stock market. If you hold on to your bond until it matures, you'll get your initial investment back. Additionally, bonds generally carry a lower risk compared to stocks. While the value of a company's stock can fluctuate wildly based on a variety of factors, a bond's value is much more stable. This is because bonds are backed by the issuer's ability to repay. Government bonds, for instance, are considered extremely safe because they're backed by the full faith and credit of a country's government. But it's important to remember that bonds are not risk-free. For instance, if the issuer goes bankrupt, they may not be able to make interest payments or return your principal. However, such risk is usually reflected in the bond's rating. The lower the rating, the higher the risk, and conversely, the higher the return. In sum, bonds offer regular income, return of principal at maturity, and a lower risk profile compared to stocks, making them an appealing choice for conservative investors. They provide a measure of predictability and stability that can be a welcome respite in the often turbulent world of investing. But just like stocks, bonds also have their drawbacks. Despite the safety bonds offer, they too have their cons. Yes, bonds are generally seen as a safer investment compared to stocks, but this doesn't mean they're without their own set of limitations. For starters, bonds typically offer lower returns. This is because they carry less risk, and as you may know, in the world of investing, lower risk usually equates to lower returns. Then there's the risk of default. Even though bonds are considered safer, there's still a chance the issuer might not be able to make their promised payments. It's not a common occurrence, but it's still a risk that should not be overlooked. Lastly, let's touch on inflation risk. If the inflation rate rises significantly during the term of the bond, the fixed interest payments could lose purchasing power. In other words, the money you get back might not buy as much as it did when you initially invested it. So, stocks or bonds, which is a better investment? The choice between stocks and bonds ultimately depends on your investment goals and risk tolerance. Let's quickly recap what we've learned. Stocks, owning a piece of a company, can offer substantial rewards, making them an enticing option for those willing to weather the storm of market volatility. They may be the ticket to high returns, but remember, with great potential reward comes substantial risk. On the other hand, bonds, essentially loans to a company or government, provide a steadier, more predictable income stream. They're the tortoise to the hare like stocks, slowly but surely generating income with less risk. However, neither is a one-size-fits-all answer. Your individual financial situation, your investment horizon, and your ability to stomach risk will influence your decision. Remember, the best investment strategy often involves a mix of both stocks and bonds. Your portfolio could benefit from the potential growth of stocks and the stability of bonds. Happy investing!